to do tax planning for an individual. Hi everyone, my name is Nicole Green. I'm one of the fabulous tax advisors at Robert Holland Associates. Today, we're going to talk about tax planning for individuals. A lot of times people think, hey, if I'm on W-2, if I don't have a company, how do I do tax planning? As individuals, you should do tax planning. It's very, very important. We're going to talk about all the ways that you can do tax planning as an individual. This is going to include credits. This is going to include your itemized deductions, HSA plans, retirement. All of this goes into your tax liability and is very, very important and can help you control your tax liability. Before we get started, do not forget to hit the like and subscribe button so you don't miss out on our latest video that we upload. Okay, here we go. Let's talk about how to do tax planning as individuals. First and foremost, one of the biggest things when you're talking about tax planning for businesses, or businesses all funnel out to individuals anyways, and so it's a really large part, is retirement. Retirement is a really good thing. Retirement is something that people do not focus on, and usually until they're older, and thus have not always hit the mark and usually try to do a lot of catch up. You can look at the laws of retirement to see that the government has put in rules to help people with that catch up because they understand doing retirement contributions in your 20s is not so common. However, it's so much more valuable. Compound interest is a thing. Putting money away in retirement in your 20s is equally as valuable as putting 10 times that away in your 60s. Looking at your retirement contributions is a great way for you to minimize your tax liability. The retirement contributions for a 401k, IRA, whether it's a traditional IRA or a Roth IRA, change every year. Your contribution limits for your retirement changes yearly as they increase with inflation and the different governments that we have. So it's very important that you pay attention to what that retirement is. Right now, we're looking at your retirement contribution on an individual side for a 401k at $23,000. You can also do a catch-up, so if you're over 50, you can put in an extra amount. This $23,000 putting away into retirement is actually quite a significant amount of money. Not everybody is able to put $23,000. However, you actually are able to. It is actually reasonable when you realize you're putting money away not into a better savings, because it's a savings that is going to grow for you. And you're also reducing your tax liability. So understanding and shooting for that $23,000 maximum is a extremely valuable thing. Otherwise, you're just going to be giving money to the government. You're giving it to the feds and to the state. And so putting money away for yourself is really, really, really beneficial. I always recommend for my clients, especially the clients that are not used to putting away such a large amount, because I get it, it is a large amount, to put away something. It's not 23 or nothing. You could put away 500, you could put away 1,000. And every year that you put away XYZ amount, you're going to get more and more comfortable with it. Think about it like when you rented your first apartment. It was a shared apartment and you were paying, I don't know, $800 a month, and that was such a stretch and it was super hard for you, but you figured it out. Now you're fully grown and your mortgage payment is $7,000 a month and you manage to do it because over time you get comfortable with the numbers. And so over time, it's very easy that you can learn to be able to put $20,000 away. Then one day you realize your retirement is actually quite a good nest egg, over $1 million, $1.8 million, let's say, $1.8 million of a retirement that you can now go and use to purchase a house. Yes, you can use your retirement to purchase a house. You can use your retirement to invest in another business. If your retirement is sitting at $10,000, $50,000, $100,000, no, you really can't because it's not large enough. And so you need to take the time slowly but surely invest in your retirement so then you can balloon that retirement to other things, and you can use that retirement that you've invested in to actually go and invest other things, and it can double and triple without any effort on your part. It's just a matter of you being able to manage that money and, find the opportunity, obviously. And so putting away money into your retirement not only reduces your tax liability, not only helps you so that you have a savings, what you can use in emergencies, you can use for your kids. And it also not only does that, it also is a great way for you to invest in things that you want to. Your retirement is not always controlled by stocks and bonds and stuff. You can have control over it. So investing in yourself by putting away money into a retirement is a great way for you to reduce your tax liability. And with some great tax planning, we can make sure that you've maximized that. Another thing is an HSA or MSA. An HSA is a health savings account, and MSA is a medical savings account. These accounts and programs are offered through your health insurance company, and depending on what health plan you have, but they're very, very valuable because you're able to put money into these accounts tax-free. You're not going to be taxed for them, and use that money on things that you're already using for. Depending on which one you have, whether it's an MSA or an HSA, will determine what you can use it for. But most of them you can use for your co-pays, for the prescriptions, for vitamins, things that you're using things that you're buying at CVS or Walgreens or whatever it is. And you don't need to max them out and put the $8,000 you have for the family plan, and you don't need to max that out. You can put in something that you're regularly using. And so doing some planning and understanding how much you're spending on your medical, if you're spending, I don't know, $5,000 a year, $10,000 a year, if you have an odd year, okay, maybe you need to average it out to what you normally spend, so you know what you can put into that, so that you're now able to have this deduction. And these small bits of a deduction, because I get it might not be that much money, it might be a few $1,000s a year, but that's a few $1,000s a year that you're not getting taxed. Imagine you're at a 20% tax rate. You just saved yourself a couple $100s and you didn't have to do anything. You didn't have to really change anything into your life. You just got a plan and put some money into it. That's worth a couple $100s to me, if you ask me. And finding different ways to save a few $100s actually adds up. And that you can realize you're saving now thousands of dollars by not doing anything different. You're not changing anything. You're not spending any more money. This is the same amount of money that you would have spent. You're just now saving more money and keeping more money for yourself, so you can say thank you to me and send me flowers. So when you're doing your tax planning as an individual, W-2, have your own business, all of it, you need to really look at what your retirement contributions are, your retirement plans that are available to you. Are you eligible to have a Roth? Are you eligible to have a traditional IRA? Do you have a 401k? Does your company offer something else? Are you maximizing these things, seeing how much additional tax you're paying because you're not maximizing these things is very, very important. Understanding how much are you spending on your medical expenses for you, for your family. Is it an option for you to have an HSA? Also, keep in mind, some of these plans you can roll over. I forgot to mention. Some of the plans you can't, and so you need to make sure you're knowledgeable about what your plan is. But some of the plans you can roll over. And so then you just have this nest egg, which is health insurance. You have this nest egg sitting there available to you tax-free. So if you do have an emergency, you spend, you put $4,000, $5,000 into your health savings account, and you're rolling it over every year. Before you know it, you have $20,000. So when you need to have that dental surgery, which can easily cost 20 grand, you have the money, and it's you have a tax-free. And so now that $20,000 is quite a big difference than your $200,000 dollars of tax saving. The other thing that you should really look at when we're doing tax planning for individuals is itemized deductions. Itemized deductions, so many people just write off and be like, okay, yeah, whatever, I have my mortgage interest. Itemized deductions are way more than what just mortgage interest. You either take the standard deduction or you itemize, one or the other. The standard deduction just includes all of the itemized deductions into one. And so you will always just take the larger amount. Some people really push to have itemized deductions, and it's like, you just want the larger, whichever one is larger. Sometimes your itemized deductions can be low. For example, if you do not own a property as a primary residence, you might not itemize, because one of the big things that gets you over the amount of a standard deduction is your mortgage interest and your property tax. So you have 3 different things that you can contribute to and 3 different things that you spend money to make up your itemized deductions. Your SALT taxes. SALT taxes is state and local taxes, that's SALT. You have the mortgage interest, you have the charitable contributions, and you have medical expenses. So I really advise people to really focus on the 3 and not 4, because the 4th one of the medical expenses is it's not common that it actually comes into play in a very significant amount. You do need to account for your medical expenses, and you should be tracking your medical expenses because it can. Medical expenses don't always count because the first 7.5% is not deductible. The first 7.5% of your AGI is not deductible. And so if my AGI is $100,000, the first $7,500 of medical expenses is not deductible. $7,501, I can now deduct $1. And also hitting that 7.5% is, you have some really high medical expenses, and I hope to Buddha, God, and all of the peoples out there that you don't have really high medical expenses. So really people should just focus on the 3, which is SALT taxes, which are going to be the taxes you pay to the state already, the ones you paid in that year. Your property taxes, sales tax, if you have a local tax or a county tax or something like that, these are all SALT taxes. And then you have your mortgage interest. And so if you have, let's say you are one of those really great, smart people and got in at a mortgage rate of like 2.5%, your mortgage interest might not be that much. And especially if you've lived in your house forever, or you're in a low tax state or something like that, your mortgage interest might not be that much, and your property taxes might not be that much. Thus, it doesn't really make sense for you to itemize. It might be easier for you to have to take the standard deduction because it will be higher. Your mortgage interest, you're able to take up to $750,000 of your mortgage. What does that mean? It means that if my mortgage is $1 million, I live in California, so this is very possible. My mortgage is $1 million, and I pay $10,000 in mortgage interest. Not my mortgage payment is $10,000, just the interest from my mortgage. And I paid $10,000 of mortgage interest on my $1 million mortgage. I cannot deduct that full $10,000. You're going to deduct only $7,500 of my mortgage interest, because the mortgage interest limit is $750,000 of mortgage. Now, if I have a mortgage of $700,000, which is below the $750,000, and my mortgage interest is still $10,000, I can now fully deduct that $10,000. So what happens to that $2,500 if my mortgage is over $750,000? In my example, my mortgage is over $750,000 because it was $1 million and I had $10,000 of mortgage interest. So that $2,500 doesn't go anywhere. If you have a good tax accountant, they can help you get it in a little bit, but really that's just gone. So you've got your mortgage interest, you've got your property taxes and your state taxes and sales taxes that is capped at $10,000. And then you have your charitable contributions. Your charitable contributions are considered non-cash contributions and cash contributions. So when you're giving money to a GoFundMe, or you're giving money to, I don't know, the Girl Scouts, or I don't know, somebody's basketball team that needs to go somewhere to play in the championship, whatever, you're giving money to those people. That is a deduction. The clothes you drop off at the Salvation Army. And those things is one of the things that people don't realize, and it's so easy to get in as a deduction. You should always, every year, make sure you're going to, I don't know, Salvation Army, Goodwill, give them something, and so that you can get that deduction. It's going to be usually fair market value or appraisal value of the item, and your tax accountant can help you with that because it's not super difficult, but make sure you're getting the coupons to show that you actually did those types of deductions. So, main ways to help people and do tax planning for individuals is looking at retirement contributions, making sure you're maximizing those things because there are different limits and you can combine them. And putting money away for your retirement doesn't mean that it's just going to sit there until you're 65. You can use it. So maximizing your retirement contributions, building up the muscle for putting money away. Putting money into an HSA, MSA, FSA plan to make sure that you're going to be able to have tax-free on the income that you use for these expenses already. You have expenses that are going to be, that can be tax-free depending on what plan you have. And then making sure that you are itemizing your deductions or maximizing the itemized deductions, including everything in so that you can be more than the standard deduction. Oh, sorry, one more thing as a little bit. There's also credits. You could also make sure you're utilizing credits. So me as a tax advisor, people sometimes ask me, like, why do you have to have appointments with your clients? And I say appointments with my clients are actually really, really important. They're like, can't you just do all the numbers and do everything and then just send your clients an email? Actually, I can't because I do more advising than actually preparing. And so I need to, one, make sure my clients understand what's going on, but really, being able to utilize credits is really a big part that comes in. And this happens through those conversations because my client mentions how they bought energy efficient appliances because they were talking about their house and how they had to put money into getting the new refrigerator. And I'm like, was it energy efficient? They bought a new washer. This happens just generally in a general conversation because when they're filling out the information about their tax, so they're not thinking about the $2,000 or $3,000 or $4,000 that they spent on a washing machine or their refrigerator because they did that 9 months ago. But during the conversation, when I'm chatting with them about life and everything, it comes up. And I'm like, oh, you spent this money, we can get a credit. Credits are better than deductions. Credits actually cover tax. Deductions reduce the taxable income and then you pay tax. But credits actually cover the tax, so they're more valuable. Getting a $30 credit could be more valuable than getting a $3,000 deduction. And so you might be eligible for credits. Non-refundable credits are really great credits. Refundable credits people like, and I get why they like it because it's literally free money. The government is not going to give you money if you didn't use that money to go against your tax liability. What do I mean? I know, I said a lot of tax words. I mean, let's say your tax liability is $10,000 and you got a credit for $11,000. If it is a refundable credit, that extra $1,000 because your credit's 11, your tax liability is 10, that extra $1,000 will actually be paid out to you. Given to you, not paid back. I'm not talking about your withholdings. I'm just talking about the credit. And so that's literally the government just gave you free money. If it's a non-refundable credit, if your tax liability is $10,000 and the credit is $11,000, that $11,000, if it can roll over, if it can carry over to the next year, you can carry it over, but maybe it can't. It depends on the credit. Why do I say non-refundable credits are better than refundable credits? Because refundable credits are going to increase your chance of audit because the government's giving you money. And so they're going to pay attention a lot more to what you're doing, going like, why do you qualify for us to pay you? They want you to pay them, not for them to pay you. And so obviously they're going to look to see a little bit harder. And people that qualify for non-refundable credits maybe make mistakes a little bit more, maybe. I don't know. They do. I do know. But, okay, so we've got maximizing your retirement contributions. We've got your HSA, MSA, FSA plans. We've got itemized deductions. And then we have credits. These 4 things are really, really great ways for you to affect your tax liability. Yes, you might not be able to affect your tax liability as much as somebody who has a business, but you absolutely can still affect your tax liability, and you can still save yourself money for whatever you want to do with it. So I highly recommend that you take some time to do a little tax planning, regardless if you have a business or you're an individual or whoever you are. Everybody needs to do tax planning. It's the beauty of paying taxes in the US. It's actually a good thing. If you still have questions, please feel free to contact us. You can click the link in the description box. You can go to our website, roberthalltaxes.com, and you can set up a free 30-minute consultation with me or one of my amazing colleagues. Thanks so much. See you guys on the next one.